So everyone, how we doing today? I'm in a good mood today because after like a month of being closed, Seabreeze is finally open again this evening. So everybody knows I'm going to get my cheeseburger tonight. I told my mother that because I text her every morning, and she says I have a cheeseburger addiction. My own mother says that. My own mom. Can you believe that? But yeah, we're gonna ignore that for the time being and say that my mom loves me. I think she does, but maybe this is just like an intervention. Okay, before we get to the main event today, which is going to be our interrogation activity, we're going to spend probably not nearly enough time talking about WorldCom. So when we talked about the fraud last Thursday, that was a simple misappropriation of assets fraud, which is just theft. That's all there really is to it. And there's not really too much detail that we need to understand about theft. Somebody steals something. And we're going to see that several times throughout the semester, and it's going to be a recurring theme. But we need to talk about this type of fraud, which this is considered to be a financial reporting fraud. This is when financial information is misrepresented to stakeholders. And so WorldCom kind of has the dubious distinction of being the largest but most ignored bankruptcy in U.S. history. So everybody it's kind of like the middle child of frauds and bankruptcies. Because Enron was first, and everybody was like, "Oh, Enron, you're so special." And then WorldCom came along, and WorldCom was like to the tune of $100 billion, which everybody's like saying, $100 billion is not that big a deal. We had 60 billion with Enron, and that was pretty big enough. And then everybody was really anchored to 6 years later when Lehman Brothers collapsed, and that was $600 billion. Ooh, that's really impressive. So again, WorldCom kind of fits in the middle, even though there's some interesting stuff going on there that people just don't talk about a whole lot. So as far as the summary of the case of the key party goes, I want to talk about the summary of the case, and then I want to talk about some things that need to be known in order to understand the nature of this case. So I have written down, and I did not use AI for this one. I actually did this one on my own because, why not? Massive long distance telecom carrier starts to lose money in the age of the internet. To stay afloat, they start recording prepaid expenses and assets called prepaid capacity. And that's an important term to note because that's actually in the Wikipedia article. They talked about the nature of prepaid capacity being the source of the fraud. So let's go ahead and break that down. And again, for the accountants in the room, this is not going to be an unfamiliar territory, but if you're not an accounting major, this may be something that's like, I'm not sure what this means or how to represent this. So let's go ahead and break down what we mean by this term prepaid capacity. So just as general terminology, if we're talking about how to calculate income, what are the two most important elements in calculating income? And again, I'm talking about a very basic level. I'm not going to get down into the details as well. You probably mean gross profit, Dr. Barnes. I said, yes, I know. But at a very general level, what do we mean by income? Revenues minus expenses. That's all there is to it. If you think about how much income you have, that's probably how you think about your income. It's like my revenues are X amount, my expenses are Y amount. The difference between those is hopefully a positive number. If that's a negative number, by the way, you're doing it wrong. All right. So keep that in mind. Revenues minus expenses. So in fraud, financial statement fraud, organizations are ultimately trying to pump up that income number. They're trying to make that larger. So we know that income is calculated as revenues minus expenses. And we know that we want to make income larger. So what are the two logical ways that an organization could do that? Increase revenues, or they could decrease expenses. All right. In many of the situations that we've looked at or that we'll look at, and then you looked at in other previous courses, the inflation of revenues was pretty much the direction that a lot of organizations went. And we talked a little bit about that, on Tuesday, I believe. But in this case, they went kind of in the opposite direction. They said, we're going to reduce our expenses. Now, this is something that's a little bit more subtle and a little bit more distinct. So I want to think about this, how this is represented. So let's say that somebody goes to the store, buys about 5 pounds of hamburger meat, a dozen hamburger buns, some cheese, some pickles, all the good fixings for a cheeseburger. How should that be accounted for? And by the way, this is a trap, okay? It's always going to be the answer that we have in all accounting classes. It depends. What does it depend on? It depends on the use of those materials, okay? If it's somebody from Burger King saying they've run out of materials for hamburgers for the burgers that they're cooking, and they went to the store and bought that and to use it to make more burgers, what do we consider those costs to be considered as? It would be inventory, okay? It'd be inventory. So it'd be inventory until they sell it, and then it would be cost of goods sold, all right? So it would be recognized as an asset, specifically inventory. Now, if Dr. Barnes takes all those and goes back and has a cheeseburger feast back at his house, can I treat that as inventory for my own personal cost? No, I'm not going to resell that. I'm going to actually incur those costs as they take place, okay? So it's going to be an expense. Now, why is this distinction important? Well, there's basically the same activity, going and buying the ingredients for burgers, that can be treated two different ways depending on the context for the usage. And that distinguishes whether we're going to treat these items as assets or expenses. And that's the crux of this prepaid capacity argument. Now, if they recognize it as expenses, then those expense amounts are going to be large and income is going to be reduced. But what happens if we shift those expense items into being cost of assets? So they get recognized. So income in the current period goes up because expenses go down. Now, does that mean that income over the long term will be affected as well? Yeah, because we know that those expenses are going to eventually be recognized when that inventory is used. It just increases income in the current period. So that's the nature of the particular fraud that we're dealing with here. Now, you maybe are asking, well, this is not cheeseburgers, Dr. Martin. So first of all, everything breaks down to cheeseburgers, okay? There's that argument. But secondly, we're not dealing with necessarily cheeseburgers. We're not dealing with that. We're dealing with something called line costs. And they talked about the infrastructure that they were leasing from other organizations. And to summarize this a little bit more succinctly is that you had kind of regional suppliers of long distance telecom and internet services across the United States. And so WorldCom, I believe they were in the Northeast, but I could be completely wrong about that. Maybe it was the Northwest, Midwest. But WorldCom was kind of the supplier there, but they operated throughout the United States. And if they ever got services that were provided to somebody in another part of the country, they would lease those from whoever the operator of the infrastructure was in that area. So say that they were leasing from ACCT, they would use that infrastructure. Now the question is, should this be treated as an asset or an expense? And what they allude to in the case, what they talk about is that this should be treated as an expense. Those were the rules in the industry at the time, should be capitalized as an expense. So expenses should be a certain amount of money. What WorldCom did is they said, we don't have to do that. We could recognize them as assets and just recognize the expenses over time. So it reduced that expense amount and income was increased. Now, that is the crux of the fraud. It's not particularly difficult once you kind of understand the basic nature of it. And the problem with this is that these amounts that they were doing were so incredibly small that it was really hard to track. It was not, they were not booking like $3 billion of fraud at a time. They were booking like a few $100s of fraud for every transaction, but doing this thousands, if not hundreds of thousands of times. So that's kind of the nature of the fraud. All right. So the key parties, Bernie Ebbers. All right. Who was Bernie Ebbers? The CEO. Okay. And I also have aspiring villain on Yellowstone. Okay. I thought about that because they said he had the largest privately owned ranch on planet Earth. That was actually a direct quote from the video. So yeah, and he kind of looked like a character on Yellowstone. If you ever watched Yellowstone, you know what I'm talking about. If you're not, just imagine a really, really bad cowboy. All right. Then Scott Sullivan, CFO, and I also have Saturday morning cartoon villain. He just kind of sounds like one of those like the ones with the twingly mustache. I know he didn't have a mustache, but kind of like twirly mustache and like yeah, that's kind of how I imagine Scott Sullivan. David Myers as head accountant and Sullivan scapegoat, and then Cynthia Cooper, who's our heroine, is the VP of internal audit. We're going to talk a little bit more about Cynthia Cooper, but her group is actually the ones that discovered the fraud and kind of it all came down. So the financial impact of the fraud. So the original discovery of the fraud. What was the original discovery for the amount of fraudulent entries? Did anybody capture that? Yeah, so they said 3 billion, and then they revised that to for over a 5-quarter period is 3.8 billion. The eventual fraud over a 3-year period was how much? $11 billion. Okay, so the financial impact of the fraud was pretty substantial. But if you ignore the fact that took place, this led to the direct collapse of WorldCom. This led to the direct collapse of WorldCom, and that was a $107 billion bankruptcy with 17,000 employees laid off. So massive impact. And keep in mind, this was in the wake of Enron, where there was already a lot of uncertainty in the in industry and in the professions in general, and this did not do to help. By the way, did anybody catch the name of the auditor for WorldCom? It was a very well known organization. Anderson was also responsible for what other notable entity? Enron. Okay, so Enron had actually just collapsed, and then Anderson was like, "Oh wow, our bad. It'll never happen again." Then WorldCom collapses. Oh, did we say that out loud? Yeah. So certainly problematic when we talk about the nature of Anderson, and Anderson did not last long after that. So let's go ahead and talk about the fraud risk factors that were listed. So some of these were explicitly talked about in the case, and some of these are a little bit more subtle and distinct. So we talked about pressure. The pressure is pretty obvious. Pressure is pretty obvious. They're operating in long distance telecom, and they're trying to move over to internet. So long distance telecom, and I know nobody was alive except for me in the late 2000s, or early 2000s, late 90s. But what can we characterize long distance as? By the way, does anybody know what long distance is? You're like, what long distance? What's that, Dr. Barnes? So it used to be that when you made a phone call, you had local and long distance. And local calls were generally free. Long distance calls you were charged for. And they were a long distance carrier. But with the advent of the internet, what happened to long distance? But he said, we don't have to use this. We can just chat over the internet. We don't have to like that. Everybody started feeling that long distance could actually be done in a cheap manner, if not completely free. In fact, I don't think we pay long distance charges anymore for the most part. And there's some situations we might. But yeah, they were a long distance telecom carrier, and they said, "Oh, we've got to change our business model. We're going to move to the internet." And then, of course, the internet bubble burst, and everybody's like, "Okay, we don't need this infrastructure anymore." And WorldCom was kind of left holding the bag. So yeah, they basically had declining performance. And we're going to talk a little bit about that when we talk about some of our primary lessons. Also, can we say identify any other pressures that might be a little bit less obvious? I'm going to say specifically related to Bernie Ebbers. So he basically got this massive contract for compensation. He said, "I'm going to spend all the money." And when I say all the money, I mean all the money. So he was like, bought a yacht, he bought a ranch. He just basically said, "I'm flush, I can afford everything." And then he said, "Wait a minute, I don't have that much money." All right, don't have that much money. So they talk about the $408 million loan that he had to take out for the organization. It's like, if I had to take out a $408 million loan, I'm not quite sure what I would do. I'd probably just go to the streets to spare change. Yeah, because I don't know how it would actually, my mind would break. Okay, my mind would break. What about rationalization? There was a statement that was made in the video that I thought was really important for rationalization. So it says, "It will all be fine in the end because the pair would figure out the problem by the next earnings release." That was when Sullivan actually forced Myers to make an adjustment to increase sales. And then immediately after that said, "It did not fix itself in the next period." It's like, yeah, this is wrong. We're going to fix the problem. We're going to make money in the next period. So let's just go ahead and book it a journal entry for additional revenues, and then we'll fix it. It's like, oh, wait a minute. This is what we're experiencing now. This is the way that business is right now. So yeah, certainly problematic in that situation. Anybody get into something for opportunity? It's not really alluded to, talked about opportunity, but the fact that Sullivan was able to make these journal entries without any scrutiny. First of all, we're talking about the highest level of management, which there's not really as much oversight. But the fact that Sullivan made these journal entries and there was no scrutiny of them certainly is problematic. And again, this is outside of the scope of this course, but I'm just screaming to myself, "Where was the auditor?" It's like, "Oh, it was Anderson." Okay, yeah, okay. So yeah, that was kind of the case there, but little no scrutiny in that. What about the primary lessons learned from the case? Did anybody learn anything from this case? This Bernie Ebbers was an interesting guy. I feel bad. I don't like talking ill of the dead because Bernie Ebbers passed away a few years back, and it was not a good, pretty situation. But he's just kind of a larger life individual. At least that's the way he was. And so, I think my primary lesson from this one was when economic conditions are unfavorable, you should be suspicious of any organization that's reporting success. And that is common with a lot of frauds that we can see, especially those in the early 2000s. There was an economic downturn because of the crash of the internet bubble or the internet bubble bursting. And that basically kind of led to a lot of organizations having business struggles. But some businesses were doing really well. Enron, WorldCom, and we said, wait a minute, this doesn't make any sense. Oh, they're committing massive financial statement fraud. Makes perfect sense. Yeah. Any other lessons that you all identified?
I
So quiet. So go ahead.
don't blindly follow like the senior employee, like actually look into stuff.
Yes, and so that's something that the culture was kind of not really adamant about back then. It's like, okay, the people at the top, we follow them, and whatever they say, we do. And I've got an interesting personal story about that. We don't really have time to talk about it, but we'll go into that a little bit more. It has to do with my father and one of his old jobs, actually right around this time. But yeah, blind following of leadership is something that we're kind of getting to the point now. We're saying, no, we don't just do that. We don't do that anymore. 25 years later, we've evolved beyond that. But what were you gonna say, Jared?
I was gonna say the same thing, but I can just say a different thing that I had.
Okay.
collateralizing loans with stock might not be the best idea, especially from a bank.
That is something that a lot of organizations do not do anymore, but it was very common back in the late 90s and 2000s because everybody's like, the stock market's never going to collapse. And yeah, so there was, yeah, I was gonna say Enron did the exact same thing, and it was one of those things that they realized in hindsight was a bad idea because people who had pensions in Enron stock basically had no pensions anymore, which is it's a tragic oversight because these people were trusting these organizations to manage their pensions effectively, and people who were close to retirement basically found they had nothing. And so that is a tragedy. I feel bad when the market downturns and I go look at my 401k. It says, what happened? Somebody took a knife to this. I can't imagine losing everything. That would be awful. That would be truly awful. I wanted to make one other note. So it's very interesting. Who do you think that people were who villainized immediately after the debacle? Do you think that people villainized the CEO, the CFO, like Bernie Ebbers, Scott Sullivan? Do you think that they were the ones that people said, you are awful, you're terrible, you're the one to blame for this? Who do you think that received the majority of the blame early on in the debacle? Cynthia Cooper and the internal auditors. Internal auditors did. So there's actually an article that talked about the article that I was reading is a little bit, it's pretty old, but it talked about the routine they went through and they found it. And they basically had like sleepless nights and they were suffering from stress and they were trying to determine if they should report this or not because they knew it would be the end of the company. And then finally they reported it. And the employees didn't say, thank you very much for doing this. It's very, very good that we found this out. They said, you cost us our jobs, you awful, horrible people, you. That's just terrible. Somebody discovers this massive pervasive fraud that's just gonna only get worse over time. And they say, let's stop this before there's too much of a tragedy. And everybody comes in and says, you are just the worst. Okay. It's just, yeah, that's that. I can't imagine what that's like. It's like doing something right and getting blamed for it. That's the worst part of it. Then, okay. Yeah. That's not the real high note that I wanted to leave us on, but yeah, that's kind of where we're at when we talk about this. It's a fascinating scandal. There's a lot more to it than this, and certainly a lot more rigor that we can go into it. But like I said, I wanted to spend enough time that we could talk about the quiz and we could actually have our time for an interrogation. So here's what I would like to do. We're going to do our quiz next. Once we finish the quiz, we'll review the quiz, and then I have some notes for you for the interrogation.